Yeah, stocks in the U.S. are flirting with new records on the news that the U.S. and China cooled tensions over the weekend, laying the groundwork for President Donald Trump and China's Xi Jinping to clinch a trade deal this week. Let's welcome Mark Luschini, Chief Investment Strategist at Janney Capital Management, to talk a little bit more about that. And Mark, thanks very much for joining us.
Thank you for having me.
Your thoughts on this trade deal? Is it expected or a little out of the blue, and how are the markets reacting to it?
Well, I think the fact that it came together rather quickly didn't leave a lot of opportunity for markets to already discount the prospect that it's going to lead to some kind of a deal between Presidents Trump and Xi. The fact that the summit occurred here just this past weekend and the news that was delivered by Treasury Secretary Bessent was surprisingly good. That would lead to the prospects of the meeting that was anticipated later this week, but not necessarily that would culminate in a détente. Is certainly helping to put a boost into equity prices as investors are somewhat relieved that the escalations that were bantered about in advance of these discussions in terms of hiking tariffs and as well keeping trade activity concerns simmering with regard to rare earth metals and soybeans and fentanyl and so on was going to obviously result in some kind of mayhem that would be disruptive to equity investors' otherwise enthusiastic attitude toward the stock market.
Did one of them blink, or did both of them have to blink on this?
Well, I think there's something to be gained and lost for both parties here. I mean, obviously, China has some leverage in this, given the U.S. is beholden to them for rare earth metal processing that's so important to so many facets of our country's industries, namely semiconductors and aerospace and defense. But on the other hand, we are the world's largest economy here in the United States. And even though it's become a shrinking percentage of the total Chinese exports that go out around the world, is still significant enough that any further curtailment of trade with the U.S. would impair economic activity there, which is already slowed to a pace that's slightly below that of what they're targeting for a 5% growth rate for 2025.
Let's come a little closer to home and talk about that government shutdown, the lack of numbers. How much is that affecting the markets, or is it affecting the markets right now? And what are the things that you would like to see?
Well, certainly the job market is key here. The market seems relatively nonplussed by the fact that we haven't had a monthly jobs report and even the weekly jobs claims numbers that are insightful now for some time. On the other hand, there's anecdotal evidence that can be found in some of the regional Fed surveys and things like the S&P Global Manufacturing PMIs on manufacturing and services that provide some evidence that the job market hasn't completely stalled out. But key, obviously, will be what the Fed's interpretation of their anecdotal data is telling them with regard to the rate setting meeting that'll be coming up later this week and again in December. And I think ultimately it's going to be important that the job market at least sustains a relatively sturdy pace, and otherwise market participants might be somewhat disappointed that the valuations that have been afforded stocks predicated upon a relatively decent economy that's promoting strong earnings growth could be undermined.
Okay, and then of course the rate cut. I think I saw 96% likely that we're going to see the rate cut on Wednesday. Has everybody already factored that one in?
Most definitely. It's all but certain at this juncture. The question is really now more around December, and maybe we'll learn something about the thinking behind the FOMC's meetings discussions when Jay Powell holds his press conference subsequent to the meeting this week.
And I know inflation came out last week, but it ties in with that. It's staying stubborn at around 3%. Is any concerns that it might start wearing the economy down if it goes longer, or is it something that everybody can absorb?
Well, I think it is concerning. I mean, there's been talk of this so-called K-shaped economy in which the more affluent continue to be remarkably resilient with regard to their strength in spending. But on the other hand, lower income cohorts obviously are facing obligations, financial, cost of living and otherwise, that 3% run rate on inflation is chewing into wage growth to the point where it's almost a push against, on a real basis, wage gains that have been made for for those households that are living more on day-to-day expenses. And so as a consequence, it's a battle that is not going to be not continued fought by the Federal Reserve, but obviously they've shifted their attention in the meantime to what looked like some softening labor conditions.
And then last but not least, it's the big thing everybody's got to focus on as well as the earnings. The Mag 7, we're going to see 5 of them this week. What are you expecting? What's a success and what's a failure for them?
Well, certainly, expectations are running pretty high for the Mag 7 and really for the market at large. So far, with about a third of the S&P 500 having reported, earnings are coming in much better than expected. The same is true for revenues. Earnings growing about 9.5%, at least reported so far on a year-over-year basis, which again, in the aggregate is better than expected. But, it's the Mag 7 that does a lot of the heavy lifting to the index at large. So key will be not only the fact that they deliver on expectations, but hopefully if past this prologue exceed those expectations to give another leg up for equity markets. Otherwise, their valuations may be subject to some compression. And as a consequence, their disproportionate weighting in the market at large could put some pressure on the tape.
Okay, we're out of time, Mark, but thank you very much for joining us.
You're welcome. Thank you.
Mark Luschini is Chief Investment Strategist at Janney Capital Management.